Now today we're discussing about two companies, which is Medtech as well as UG Healthcare. But before I start, I'd like to make sure it's known that I have nothing against the board. I have nothing against the hardworking employees over at these two companies. This video is all against speculators, and if you have followed this channel, you know that I'm big on investing, I hate speculation, and that I have things to show you to actually help you become a better investor and avoid these speculative mindset mistakes. Questions like these are coming up quite often. One looks like this. Hi Josh, what are your thoughts of Medtech is skyrocketing? Another question, I purchased UG Healthcare at $3.30 and unfortunately it came down by 10%. What is your suggestion? Now this video, I'm going to run through speculators' mindset, how to identify them, why they often make losses. And as well, I have an interesting story to share with you about a company that was in the limelight of speculations many years back. I have actually a family member who lost quite a lot of money in that company. That's why I know the story inside out. And lastly, I'll help you identify what exactly is a speculative bubble. And if this video interests you, continue watching on. Hi guys, welcome back. Speculation is such a seductive idea. In a quick span of time, you can make 2 or 3 times your money. There's no need to wait for years or months. 2 or 3 times your money in a quick span of weeks. How nice it will be. That's why new investors are always trying to chat about what is the next big thing, because they always associate successful and profitable investing as spotting the next big thing that goes up in price action, and that's often not the right way to do things. Now, new investors have this fear of missing out. They're always hoping that the best would happen to them, and they're avoiding understanding how operations work, and they're always avoiding the problems in risk. And in this next segment, I'll show you exactly on day-by-day basis how things actually work with speculators. UG Healthcare's price action to show you what exactly happens to a typical retail investor. As you can see over here, which is about 15th of June, price is about 80 cents. But very quickly in July, prices went up by 2 to 3 times. This run-up very likely is happening simply because there's a lot of good operational performance. Everybody is showing better results, especially in Gulf industry. So UG Healthcare, not surprisingly, is also doing well on an operational basis. A lot of hype, and a lot of investors are actually getting in towards the top. As you can see over here, volume is high, volume is higher. So as you can see, investors are investing close to the $2 mark, and what happens next is a typical action like this. 4 straight days of bad price action. If you can see over here, this $2 to here $1.30, this is a drop of 35% in 4 quick trading days. If you invested in $10,000, you have lost $3,500. That is quite an amount just to lose in 4 quick days. Now, for any speculator, such a price action will be extremely scary. If you're a technical analysis person, these are extremely bearish signs that you should cut your losses, you should admit defeat, you should get out before it becomes zero. That's why a lot of people sell out at this point of time, if you can see over here. And what happens next? Typically, a smack in the face. Price recovers unexpectedly. It gets to a new high even. 2 times that of the previous low. And not only that, prices continue to climb and climb. In fact, it reaches now to 3 times more than the previous low. At this point of time, it's attracting new investors. The cycle repeats itself over and over again. And what happens, we do not know. Is it going to continue to repeat this action, or is it going to permanently go down? That's anybody's guess, because right now it's shaking again. So if you're a speculator, you're already at risk of a lot of things. You are not sure why you bought in. You're not sure if this is the top. This is always lingering at the back of your mind. That's why if you're a speculator, avoid it. Don't make that judgment again and speculate. If you're looking for a quick buck, you realize you get pulled in, and then once these shaking actions come in, you're the first to give it up. That is why using UG Healthcare as a price action, you can really see why retail investors typically lose money when it comes to speculating. Now let's see some financial numbers. I'll just touch on it preliminarily because I'm not deep diving into these two companies. I think it's not too worth an investment thesis. The first thing about UG Healthcare, let me show this, which is actually done by CMB, which is pretty good. As you can see boxed up in red, what I wanted to highlight to you is in terms of margins. As you can see, that is a cross-industry analysis across each and every player's operating margin. And as you can see, UG Healthcare, the net profit margin is only 2.7%, correct? If you compare that to Riverstone, 13.2%. If you compare that to Hatta Laga, that's 16.1%. What I'm trying to tell you is, as of now, there's a lot of demand for their inventory, for their products. That's why they're going to make profits also. They're going to show very good numbers for the coming quarters. But what happens when things turn south? What happens when there's an oversupply? As you can quickly expect, the player with the smallest margin is the first to go into red. Simply because if everybody cuts prices, price war happens, the player with the smallest margin is going to sell their products at a losses, and that's just logic. I'd like to also poke holes in terms of Medtech. Medtech has shown better profit margin, as you can see circled in green over there. The issue I have with them is in terms of its ability to grow its revenue and gross profits over the years from 2015 all the way to 2019. Now this COVID-19 pandemic is, a windfall for them, but how long is it going to last? Are they able to ramp up their performance consistently and able to stay relevant to higher market demands? That is anybody's guess. This is only a short-term squeeze in terms of their demand. They are not exactly like Zoom, whereby Zoom can scale things. They are a technology firm, no need production plants. They can just scale things quickly across the world. And even past this pandemic, they are still able to offer a different solution to each and every person's daily lives. They're not exactly providing an equipment that's specialized for this period. I hope that those 2 points really help you think a bit deeper if you're serious about investing in those 2 companies. Now let me share with you a story on Oceanus. Oceanus used to do abalone. As of right now, I don't know what exactly is the key revenue driver, but back many years ago, they were the champion for abalone. And this price action really shows you how good they were. Back in 2007, 2008, they actually gained 11 times. Very similar, right? Now to UG Healthcare, very similar to now to Medtech. So as expected, they were the market darlings. And for some good reason also, if you look at this article over here, you realize that prices of abalone shot up at that period of time, and that there was shortage of abalone, as I've highlighted in red, for the next 2 to 3 years. Sounds a bit similar to glove, demand and supply right now, correct? And Oceanus, they were the world's largest land-based abalone farmer. Of course, market is expecting them to do very well. I have further evidence to show you. This is actually done by a research firm. They have managed to actually extract out. And what you can see over there, forecasted in 2009, performance, earnings per share growth of 79.9%. That is fantastic. If you couple that with a P ratio of 7.5, that absolutely looks like a growth company at a much needed bargain. That's why people are so hyped up about speculating into Oceanus back at that point of time. And the story goes like this. In 2009, they actually lost 80%, but that can be attributed to global financial crisis. That's why the share price actually recovered very strongly after that. But the main key part is the right-hand arrow, the right-hand red arrow. That is where operations started to go haywire. They actually lost a lot of abalone due to some diseases in the farms. There were a lot of operational mistakes. They didn't insure their abalone. And that's why I know I have a family member that lost a lot in terms of share price. What happened is their share price never recovered. It continued to go down and down. Nobody really cared about abalone right until now even. And that's why I've this story to share with you to really enforce the point that if things are looking good for a couple of years, that may not be an investment thesis that you're going to get invested into. You're looking for companies that can invest, that can really do the operations year in, year out, good performance year in, year out. Then you can invest in them long term and sleep well. If you can't stock pick, then be diversified. Buy a fund, buy an ETF that broadens out, because stock picking requires you to look at operations, what are changing within operations. It's very difficult if you're not insider sometimes. Now, if you benefited to here, smash a like so more people can see this valuable content. And again, subscribe, join our family, become more financially savvy. Now, there's a few key parts to spot a bubble. Maybe I'm the first to call, UG Healthcare price action a bubble. I'm the first to call Medtech price action a bubble. There are some analysts who are still thinking that the price action could go higher. They could be right also, but I'm not interested to dabble in them in one way or another. So let me show you the first key sign on where usually bubbles usually spot. They are usually the small cap companies. UG Healthcare before this pandemic was worth only 30 million. As of now, it's more than 500 million. Medtech, they were 46 million. Right now, they're 900 million. Now, if someone asks you to buy a company that was a few months ago 46 million, ask you to pay 900 million, would you be so interested? If you see it from that point of view, your answer is pretty clear. If you don't see price actions, your answer is pretty clear. You're not interested. You're paying somebody 900 million for something that was worth a few months ago only 46 million. The second part to take note is about volume. Volume is a great indicator as to where speculation is taking place. Let me show you firstly on Oceanus. Oceanus had little volume. At the start, before 2007, you can't even see any bar. But subsequently, they had 50 million daily traded volume very easily. What do we see in UG Healthcare? UG Healthcare also had no volume at the start. As of right now, they are clocking in at least 20 million each day on the volume. What about for Medtech, even more spectacular? Right now they're clocking in more than 100 million in terms of volume, but before that they had no volume at all. That's to show you, these two are very good indicators. A small cap company with sudden surge in volume. If you see them avoid them like a plague, because it feels nice that you can jump in and jump out, but very often, as I've shown at the start of the video, it gets you into trouble. And again, if this video helps you answer this question, or has your friend needing this question, share this video with them. And I've also a further video to elaborate on how to become a successful investor. This video on why investors always make this mistake on anchoring buyers. I hope this video really helps you sharpen your investment edge. And I'll see you at that video, because that video certainly will help you also in your journey. With that, I'll sign off. Take care and goodbye.